Time now for today's strategy session. The S&P 500 on track for its best year since 2019 as the index continues to clinch record high after record high. But the market's biggest driver, the Mag 7, is showing some signs of pullback from its rapid growth. Joining us now, we want to bring in Jake Manukian. He is at JP Morgan's Private Bank U.S. Head of Investment Strategy. Jake, let's start right there with the role of Mag 7. As we look ahead to 2025, what's your assessment just in terms of how investors should be thinking about how critical it is for the market's continued rally?
Yeah, I would say it's important but not critical, right? I mean, these companies they're the largest shares in the index. Index concentration is at all-time highs. But the good news for investors is that their profiles are very attractive, right? They have the widest cash flow margins in the market. They have the lowest amount of levels of debt, and they have secular drivers of revenue and earnings potential. So I think they're obviously important for the market, but they're not critical for the market's success. And we see signs that earnings growth is set to broaden out as we head into 2025. And I think after the election, a lot of people are willing to kind of look ahead. That psychological overhang is in the past, and they're looking for more opportunities in all different segments of the market.
Even with regard to the concentration that you were mentioning, how and where are these sectors or even names that are perhaps most primed to take on some of that share of concentration?
Yeah, I mean, the public markets aside, I think what's really interesting is happening in private markets, right? You guys were talking about deal making and some of the merger and acquisition activity that's happened. You know, Wall Street's been in this kind of ice age for the last 2 years in terms of deal activity. When you think about IPO issuance, high yield issuance, lev loan issuance, we've seen a collapse in activity given interest rate hikes, given fears of recession, given elevated inflation, and we've seen a nascent recovery, but I think given a shift in the regulatory environment, that's really going to change. So when you think about private equity exits, private equity deal flow, when you think about the opportunity that private managers have, I think it's compelling to us.
It sounds like opportunities across capital structure.
Yeah, across the capital structure too. I mean, if you think about all of the the debt financing and the mezzanine level financing that it takes to get these deals done, we expect more volume and more opportunity there. And when we think about that from a portfolio construction angle, we're very optimistic. There's a lot of ways for investors to get those kind of like high single digit, low double digit returns. Yeah. From a lot of places, whether it's large cap equities or whether it's private markets, whether it's mezzanine debt, whether it's direct lending, whether it's infrastructure, whether it's real estate. There's a lot of different levers that investors can pull to build a resilient portfolio that can still generate attractive returns.
So the way that I'm kind of thinking about it now is it sounds like it's who's financing the deals, which leans towards financials and the larger banks.
Yes.
And then on the other side, it could be small and mid caps that are most primed to be acquired, but you'd have to be really judicious
selective
about where you're picking those.
Exactly. I mean, a better deal-making environment should support multiples and valuations for the small and mid-cap spaces. But yes, the financial sector, the asset management industry broadly, those are two places in the public markets that should benefit.
Talk to us just about how you're thinking about Fed policy and how big of a factor that is into some of these opportunities.
It's a factor, but I think investors have to understand that the Fed isn't the primary catalyst in the market anymore. They're in easing mode. There's going to be a debate about how frequently they cut or how many times they cut, but their policy stance is set towards easing. We're not seeing any signs of inflation from the labor market, and that's really what they're trying to support. And as long as that shift has happened, and it's happening globally, you saw the news from China over the weekend is that they're in that kind of supportive easing mode as well. That's happening in the background. That's the undercurrent, but that's not the big catalyst, we don't think.
And so if the Fed is not the big catalyst, is the catalyst 1600 Pennsylvania Avenue?
Yeah, well, I think that's what investors are thinking right now, right? The shift in the regulatory environment is something that we're well aware of. What we feel there's a lot of policy mix that I think investors are going to have to debate, whether that's the tariff side, whether it's the kind of labor force consequences of changing immigration policy. But there's a clear sense that this will be a friendlier administration to Wall Street and to deal-making activity, and that's where we're anchored from a perspective of where we want to add risk in portfolios.
You go back kind of to where we started talking about the fact that we are seeing this broadening here just in terms of earnings participation, where we are seeing that growth. We're expected, maybe is a better way to say that growth going forward. What are the top, I guess, where do you see that leadership coming outside of maybe some of those tech names? Who do you see leading in 2025?
Yeah, I mean, one of the sectors that we're focused on is industrials. I think there's a lot of both cyclical and secular catalysts for the industrial sector. And one of them is the kind of geopolitical environment and then this broader idea of security that encompasses a lot of different factors, whether that's supply chains, energy resource, access to energy resources, whether it's infrastructure. A lot of that investment, and globally, this isn't just a US story, will benefit members of the industrial sector.
Jake, thanks so much for taking the time in studio this morning.
Thank you guys very much.
Absolutely.
Appreciate it.